Indecision is still a decision. Hey everyone, I'm Andrew. I'm a CFA Charterholder and CFP professional who also owns Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And I've spent the last several years working with ultra high net worth and high net worth investors. And I take the stories and learnings from their complex lives and I give them to you so that you can apply it to your own life. And today I want to tell you a good way to miss out on millions of dollars in your retirement. Not clickbait. I remember meeting with a person years ago who had low-ish 8 figures net worth. COVID happens, and they were a pretty knowledgeable investor. I'll put it that way. So COVID happens, and this person had already 20% in cash, a very low spend rate. Let's say 50% in bonds and the rest in equities. And obviously the accounts go down. Not everything's in equities. And they go full preservation mode. They want to sell the equities. I say, I don't know about that. I'm not sure it's a great idea. And before we wind the clock back, some of those conversations were revolved around, hey, your capacity to take on risk here is actually higher than how you are currently allocated. And if you have big legacy goals or big philanthropic goals, you should consider having more stock exposure in your portfolio because you don't spend very much money. So their retort would be, yes, but the PE on stocks is high right now. Stock market's at an all-time high too. Unfortunately, for the stock market to go up, it has to continually hit new highs. So COVID happens, moving back here, obviously stock market goes down. And I remember when you looked at price to cash flow of some of these companies, it was like mid-high single digits now in late March. Oh, hey, this might be the time. Invest in equities. You at least have this cash. Maybe don't sell your bonds if you don't feel good about that, but you at least have this cash that you don't need. And they go, now, I don't know how COVID's going to go. And in some respects, I can appreciate that. You know, in hindsight, it was a scary time. It's easy for me to judge it now. Didn't have a vaccine, world's shut down. Well, vaccine comes out, rally. What about now? Well, there's already been a rally. Okay. Then 2021 happens. Well, you know what? Market's gone up too much. I think there needs to be a pullback. Market got ahead of itself. 2022 happens. Inflation's too high. I don't know how I feel about getting into the markets now. Inflation's not good for stocks. Well, my point with this is they couldn't pull the trigger to actually invest the money, and they wanted to. That's the difference. Some people know themselves and say, I'm not a stock investor. I don't like that volatility. This person knew it was the right decision for their situation. They wanted and understood that there was volatility associated with it, but they couldn't pull the trigger. And that's why I say indecision is still a decision, and market timing is a fool's errand. It is. There are always a plethora of good reasons to not invest. There are. But equity markets give returns because of that risk. It is a feature, not a bug. And what you are doing is you are buying a call option on the ingenuity of humans. That's what you're doing whenever you invest in the equity markets. You are saying, I believe humans can make better things, give better service, and be more productive. That's what you're doing. There's volatility associated with it. But this person very literally missed out on millions of dollars of growth because they couldn't pull the trigger. And then on the back end, there was never a good time to get back in. When you market time, you not only have to be right on when you get out, which this person was already out. You have to be right on when to get back in. The tough thing is within a market timing framework, if you go back, just go on Wikipedia, look up S&P 500 biggest up and down days. They are all clustered together. The largest movements, both up and down, happen when the VIX, volatility index, is the highest. Volatility kills returns, but it also gives opportunity for excess returns. And when so much of the return over a year is concentrated within a few short trading days, market timing is incredibly difficult to get right. And so my encouragement to you, do not market time. Let your long-term money be long-term and your short-term money be short-term. I've done several videos on ways to insulate your retirement portfolio, ways to trick yourself to feel good. Go check those out. But let your equities be what they are, which is a call option on the ingenuity of humans. So that's my encouragement for you today. Just a short little story for you. Hope everyone is doing well out there. Until next time, see ya.